The state of commercial real estate. We're talking about that more today here on the Commercial Real Estate Report. The mission of the show is to empower you to build generational wealth with real estate. I'm your host, Chris Burr, head of business development with Abernathy Holdings. We go out and we build Class A self-storage sites in California, Arizona, and soon to be beyond. Thus, the reason for our incredible guest today. I was recently up at the California Self-Storage Association event in Napa. He was our keynote speaker. He also is the head of global client strategist and senior economic advisor for CBRE. Plus, he hosts what he says is the most popular commercial real estate podcast out there, The Weekly Take, Spencer Levy. So, Spencer, welcome to the show. It's great to have you.
Thank you, Chris. And for today, we could say we're at least as equal to your show.
It's very kind of us. I mean, we'll have a friendly competition here. And First, I thank you for the time. Your presentation was fantastic up in Napa. And I want to start there. There was a line you said that really caught, I want to say my eye, but caught my ear. And you said, hey, guys, we are not in the real estate business. We are in the labor and demographics or demography business. So add some color to that and please explain.
Sure. So big picture, real estate isn't the asset class. It is a derivative asset class, and it's derivative of where labor is or wants to be, or where people are moving. So it's not true if you build it, they will come, like the line from Field of Dreams. It is true that if they're there, they need real estate, and they need multifamily, they need retail, they need office, they need everything. But unless you follow the people, you are looking at the business incorrectly. And one of the things that we're going to talk about today, Chris, is how this is a significant shift in how we look at the business from when I got into this business 30 plus years ago, where it used to be very much supply and demand and finance. Now it's where's the water? Where's the electricity? Where are the best public schools? Where is the politics the most favorable? And the chart you pulled up today from Yardi, and I happen to be here in New York City about to do a Yardi event, says exactly that. It ranks cities not based upon real estate, but non-real estate factors, including the factors I just mentioned, as the way we need to underwrite going forward, particularly if you're in certain heavy labor using or electrical using asset classes, like, say, data centers, the biggest electrical and water user, or if you're in a heavy labor using asset class like senior housing or things that require some of these other things. But also, if you want people to live there, you have to look at the public schools, you have to look at the ease of doing business as well.
So I want to run through some of that, but I also just want to push back a little bit because of one of the comments you made in Napa. So here you've got Boise, #1, Raleigh, Durham, Salt Lake City, Miami. I don't see on this immediate list the city of San Francisco. So one of the things I think that'll shock a lot of people, because we're really focused on California, you said, hey guys, if I was in the space, I would be backing up the trucks right now in San Francisco and investing in office. Somewhat antithetical to what you just mentioned about political climate and things of that nature. So why would you be backing up the trucks to buy office in San Francisco?
Well, here's the reason. Sometimes a difficult zoning board is your best friend. And the reason why it's your best friend is because it's going to keep your competitors out. And, let's run to what is probably the most challenging issue, and that gets a lot of headlines, which is some of the social issues led by crime, et cetera, in San Francisco that are turning some people off to the city. Let me cut to the chase. I live in Baltimore, and I've seen the crime issues firsthand. And it has never stopped me from being an advocate for Baltimore. And it's never stopped my biggest clients from making real money in Baltimore in the right places. And I see San Francisco not only in the same light, but in a much more favorable light, because San Francisco has the highest quality labor force in the United States by a lot. In certain areas, particularly in tech. They have a virtuous cycle when it comes to capital. They have excellent infrastructure. They have wonderful climate. But, look, these issues that are impacting the city today are your entry point, because it's going to drop materially the price of some of these assets. And when I say drop materially, I did a podcast last week while I was in San Francisco, and some of the office buildings and unfavored locations have fallen by well over 50% in value, and that's probably being kind. But there are office buildings in very good locations that I think you could get for similar values today, and they're only going to improve over time, because you could not replace the labor talent, infrastructure, capital, and overall environment of San Francisco. I love San Francisco, and I stand behind that statement.
I want to talk a little bit more about that, but as you talked about kind of a new underwriting strategy, if you will, with all these different variables, as you look at San Francisco, how would you go about, for example, underwriting office space or other asset classes right now?
Sure, and I think San Francisco is further down on that list, by the way, but I could be incorrect. But a lot of the red dots there where it's negative, like its political environment, like its ease of doing business, like its high taxes, things like that, those are true. But at the same time, you're also going to be able to get premium rent, premium growth. Did you know that 72%, and I'm going to be slightly off on that, but approximately 72% of all venture capital dollars going into AI are in the San Francisco Bay Area? So think about that. This is a still relatively new subset of the tech industry, but it's the hottest space of them all. And 3/4 of the money is going to the market that so many people are down on. And that to me screams opportunity. The other thing that screams opportunity about San Francisco is that if you look historically at San Francisco, Boston, and Austin, Texas, those have historically been 3 of the most volatile office markets in the United States. And well, the proof's in the pudding. They always come back for one reason: talent.
So if you don't mind, I'd like to just get some anecdotes because you did mention Napa as well. And here's my context of this question: is you talked about one of your buddies, I guess, is a big office guy in San Francisco. So maybe share some anecdotes there, because the people I know in San Francisco, I went to school in the Bay Area. I'm like, hey, is it really as bad as the news says? They're like, nah, it's not as bad as people say, and things of that nature. So what were some of the just anecdotes or stories you were hearing from people with boots on the ground?
Sure, I can give you both ends of the spectrum. Okay. And I think you can look at San Francisco in a very similar vein to how you can look at, say, Boston. And the reason why I put Boston and San Francisco sort of in the same bucket is because they are both, I would say, the 2 strongest educational bases in the country in San Francisco. And, the schools and the other quality of labor there. But they also have what I would call the old school CBD, which in each area, let's call it the financial district. And then you have some of the emerging areas. So in Boston, you have the Seaport, which is doing exceptionally well. And then you have areas that are pertinent to Harvard and MIT that are also doing well. It's the financial district that is doing much more challenging. Same thing in San Francisco. The financial district, where you have these enormous towers, is where it's the softest. But if you go into some of these other neighborhoods in San Francisco that have older buildings. In fact, the building I taped a podcast on, which you'll hear on the weekly take in a few weeks. Sorry about that, Chris. I had to throw one.
Hey, I'm looking forward to it.
Yeah, the company's name is Brick and Timber, and they own buildings in the most historic parts of San Francisco. And these are smaller buildings, call it 15 to 35,000 feet, and they're almost 100% leased. And they're leasing to venture capital companies. And because people want these, and I hesitate to use the word cooler, but I'm going to use cooler, adaptive reuse, smaller buildings where they can take the entire space. And these towers, where there are 60, 70, 80-story towers, where you don't have the identity of having your own building, they're challenged at the moment. Though they will recover, but it's just going to take longer for those towers to recover than will be the smaller buildings in the hot parts of town.
And to be fair to what you said in Napa too, you said, hey guys, this is very local. I mean, micro niches. I'm not talking about all of San Francisco, but there's areas where there's definitely going to be opportunity. You mentioned Boston and obviously San Francisco. One of the things, so everyone knows that there's this demise happening in office right now. The thing that I don't think gets talked about enough, and this may be a little bit outside your pure purview, but still would love your perspective on it, is as these office values decline and you've got lower occupancy, you're going to see lower tax revenue. What are these cities going to do?
Well, let's start from a slightly different place. The place I want to start from here is, how do we solve the problem? What is the path to solving the problem? And you're getting to the problem. The problem is, if we don't solve the problem, we're going to run out of money. So when I speak with political folks, and I'm fortunate, I'm the chairman of the Real Estate Roundtable's research committee, so I speak to these political types all the time. I tell them this: I looked them in the eye. I said, I don't want your money. I want my time. I want you to reduce the permitting time for me to convert this building from an office building into multifamily or another use. Because right now, if you go into a major CBD, it could take you 3-4 years before you can even get going, and if you can get going at all, right? And that time uncertainty is, to me, the primary gating issue to expediting the redevelopment of a lot of these areas. So now back to your question. So if we don't do this, the tax base is going to fall off significantly. And that's why you need the public markets and the private markets to work together here, or there is going to be this fall off, and then you're going to see this doom loop of less public services, police, fire, schools, that sort of stuff. That's the doom loop that will occur in these CBDs unless we can avoid it. And I think the best way to do it is expedited permitting. And the plan that Florida put forth, which is called the Live Local Act, it's not perfect. And believe me, there's a tremendous amount of local pushback, but it's a step in the right direction. Because what the Live Local Act in Florida does is it gives you expedited permitting time to convert an older office building if you have a portion of it that's affordable. And they're not just doing this in secondary locations. They're doing one of these jobs in Bal Harbour. And if you know Bal Harbour in Miami, it's one of the fanciest malls, if not the fanciest mall in the country. And they're putting it right on their campus because they can't get their workers to their campus. So if you can put affordable housing on the fanciest place in America, you can put it in your town too.
Very, very well said. So if you were king for a day, what would you do in San Francisco?
If I was king for a day in San Francisco, I would say that everybody who wants to convert these buildings into office, you have an as of right ability to do so, jumping over all other local objections. That's what I would do if I was king for one day. There are a lot of other things I'd do for king for one day, but that's where I'd start.
Fair. I want to get into LA in a moment as well. But first, because you're an attorney with your background, what's your assessment? And I have not perused the decision or what happened, but around the Supreme Court's decision around development fees.
I'm not entirely sure what you're referring to.
Okay, there was a recent, and maybe it was just in California, but it was a decision
Mhm.
around development fees, which has been a big sticking point for developers out here and saying, hey, wait a second, maybe the cities, like for us, for example, we've got a site we're putting up in Moreno Valley, and 1% of our development fees going to the arts, which is very, very unique compared to what we're normally used to in other cities. So let's move on to LA. There was a recent transaction in downtown LA. I believe it was the Aon building, sold for roughly $140 million.
I know the building. Mhm.
Excuse me?
I said, I know the building because one of the first deals I ever worked on was the McGuire Properties IPO back in 2000. And we put a lot of those buildings into the deal. I think the Aon building was one of them. I know the Bank of America Tower was one of them. And one of the funny little stories that happened then was we were all fancy bankers wearing our fancy banker clothes. And we went up to the heliport on the top of the Bank of America Tower, and it was windy and there was no railing. We had fancy bankers crawling off that roof. So that's my first memory of LA large towers. But go right ahead, Chris.
So I think it sold for 140 just less than a decade ago. I think the price was 247, 250. A friend of mine, Ethan Penner, who started CMBS, says, hey, I wouldn't spend $1 in downtown Los Angeles right now with what's happening. So one, I want to get your assessment there. Now, the investment thesis for the group that bought the Aon building is, hey, we're long LA because of the 2028 Olympics. What say you?
First of all, Ethan's a friend of mine too. And Ethan, rock on. I love that man.
I do too.
Maybe the smartest dude I know. Okay. And I say that on the air. But in any event, I disagree with Ethan. And this is why I disagree with Ethan. And I disagree with him because first of all, I like disagreeing with Ethan. We have lots of fun when we debate each other. But the other reason is that I think that LA has a similar virtuous cycle in media as San Francisco has in traditional tech. And while downtown LA, the Bunker Hill section where Aon is, and Bank of America Tower is, and where my corporate offices are, is going to really suffer in the short term because they're not getting people back to the offices, and the CapEx requirements to get these up to whatever you consider to be A+ standards is exorbitant. But I think that a lot of that is masked by, or rather being impacted significantly by two things. Number one, labor. What did we say before? What business we're in here? The reason why people aren't coming back to the office has nothing to do with whether or not you've got the world's best pickleball court in your building. And please, whoever's listening to this show, if you ever want to be on my show, please don't mention pickleball because it's not going to make the air. The reason why people aren't coming back is a labor versus management dispute. Simple as that. And that's why you see more people coming back in certain industries like finance and less in other industries like media and tech, and less in government because it's the different dynamic between labor and management. That's why you saw the artists strike at the same time as the auto workers strike in Detroit. It's like, what do they have to do with each other? Labor is in a position of tremendous power today because the unemployment rate is so low, and they are exploiting it in part due to hybrid work, in part due to work from home. So long, fancy way of saying this. Downtown LA is going to suffer for a while until we see a change in the labor dynamic, number one. It's going to suffer until we see a change in the interest rate environment, so capital becomes cheaper, number two. But it's really going to suffer until the powers that be in downtown LA see the light and say, we need to allow these people to redevelopment as of right to whatever use they think is going to be most productive, because multifamily is not the only solution, because most of these buildings in downtown LA are going to stay office. They're just going to be change hands, be cheaper, get better over time, but several of them are going to get converted. And we need the city of LA and other cities to work with the development community to make that happen.
So I'd like to just have you share your thoughts, your opinion on their investment thesis around the 2028 Olympics.
So mega events like that, and by the way, the Olympics last for 2 weeks. In anticipation of that, I think LA was awarded the Olympics in part because they had all of the existing infrastructure from prior Olympics and other events. So they didn't have to go through what other countries, and I'm certainly not throwing any countries under the bus, but there's a lot of countries that went or came close to coming bankrupt because of all of the money they needed to spend on venues and infrastructure to make it happen. I think the Olympics are going to help LA. Of course, they're going to help LA. I think they're going to help Paris. I think they help Tokyo. But at what price? Is it going to, are the benefits going to outweigh the cost? Of course they will, if you look at it from a big picture community perspective. But if you look at it from the stone cold math perspective, and you look at it for the long-term demand for LA office and other uses, I think it's a more complicated case.
So you talked about being a chair of the roundtable. I know part of your, at least on your bio, talks about, hey, you're doing a lot of public-facing activities within the commercial real estate realm. What's the most pressing issue you're hearing from people today? Like, what's the common thing that keeps coming up in conversations as you're talking to them?
I think the most common issue, and putting aside the macroeconomic stuff as it relates to interest rates and the challenges we have in the office sector, because those two are probably the most talked about issues. But there's some issues out there that don't typically get talked about that are really, really important. One of them has to do with foreign capital coming into your market. There are a lot of states right now that are trying to ban primarily Chinese capital from coming in, which I think is a terrible idea. I think that global trade is the best thing we can do. And I certainly think it sets a terrible precedent, because we worked for years on this thing that was known as FERPTA to try to expedite capital coming in. So that's a hot topic. Another hot topic that unfortunately disproportionately and negatively impacts California is property and casualty insurance. Property and casualty insurance have been stratospheric, and it's a state issue. It's not a federal one, though it's possible we'll federalize part of it, much like we federalized terrorism risk insurance, much like we federalized flood insurance. So those are two big issues. And here's a third one, and this is the one that I think is the hottest hot potato right now, which is the opposition to institutional ownership of single-family homes. And the opposition is fierce, not just in California, because I know California is working on it now, but it's also in so-called red states like Texas. The governor of Texas came out against it. Folks, I could not be more opposed to that sentiment, and I'll tell you why. There's only one thing that can solve America's housing crisis, and believe me, we have a housing crisis, and it is dire in California, where you're considered to be housing poor if 30% or more of your take-home pay goes to housing. In California, the average person pays 50%. Okay, that's how dire it is there. There's one solution. It's called supply. And by banning institutional capital from the single family sector, or the BTR sector, which is the portion where they actually build to rent, you are going to limit new supply. You need new supply, and the way new supply is going to show up is through institutional capital. Does it have marginal pressure on making prices more expensive? Yes. Okay, look, the guy just admitted it. In certain circumstances, it will put upward pressure on pricing. But in the near term, we need more supply. So let institutions do BTR all day long. And in the SFR space, let's think about this too. Who would you rather have as your landlord? Would you rather have the big faceless Wall Street institution, or the barber down the street? And you say, oh, I'd rather have the barber, nice person. Well, what do you do when there's a leak in the roof? What do you do when there's a problem? You need a well-capitalized landlord. May seem like an evildoer. You're much better off as a renter with a well-capitalized landlord than with a local undercapitalized landlord when it comes to problems in your space. And again, I know this is political, and I don't want to make anybody upset, mad, or otherwise. I am an affordable housing advocate. I want more supply, and the way to create more supply is more institutional capital in all segments of housing.
So I think a big part of the conversation goes back to what's happening within the municipalities and the NIMBY conversation, right? Because of the entitlements, the zoning, things of that nature.
Well, look, NIMBYism is a fancy way of saying don't build it here. And I don't want to throw California under the bus because I'm a big California fan, but they didn't bathe itself in glory 4 or 5 years ago when Article 50 didn't pass in California. And Article 50 was going to allow you to build affordable housing along transit lines, like train lines. And it went over like a Led Zeppelin with these local communities that saw affordable housing coming their way. And it's a terrible, terrible thing. And I don't want to get too deep into it, but people in local communities have to permit more housing. And let me go one step further, vertical housing, not just single family, but vertical. Because vertical housing is not only the most efficient way to build lots of units, it's also, dare I say it, the greenest way to build more units, because you can localize all of your resource uses for water, electrical, and otherwise. So it is probably the biggest political. If it's a political hot potato to keep institutions out, it's a political hot potato for the locals to keep affordable housing out too. So it's a terrible situation where you have two groups that seem completely opposite, causing the same problem, which is a reduction in supply.
Well, it's such a major challenge here because they've got a state mandate now for housing. So if you want to go build certain places, you've got to do affordable housing. Sometimes the math doesn't work, especially when you've got interest rates up. So it's a very, very interesting dynamic. One of the things you mentioned a moment ago was global capital coming to the United States. But one of the things you also said in Napa, which I think is a really important conversation, you've talked about it on the Weekly Take, is what's happening right now with deglobalization and or onshoring. You actually said, hey, this is one of the most important things happening in our industry today. Why?
I haven't had this conversation since an hour ago with a big institutional client here in New York City. And look, I make mistakes, and I'm the first person to admit my mistakes on talking about the direction of interest rates. Okay, we blew it, just like 99% of Wall Street blew it, but we blew that. But there's some areas where I didn't blow it. And one of the areas where I got it right a long time ago, and I got thrown out of a lot of meetings for saying this, was 5 years ago. I said that open air retail is the most undervalued asset class in real estate. And I said it because open air real estate, we weren't building any more of it. Fundamentals were improving. The consumer was strong, and doggone it, I was right. Not only was I right then, but I mean even more right now, as people have cycled out of office and into open air retail. Which brings me to manufacturing. So here's a statistic that I will get slightly wrong, but this is approximately right. So we try to track the number of large developments going on in the United States. And based on our estimate, and again, slightly wrong, we estimate there's about 32 developments going on right now, manufacturing developments that are $1 billion or more in value right now. You say, well, what does that mean? Well, in 2009, there was one. And if you're a Vegas fan, that was the Aria and the Mandarin Oriental development by MGM. And so what does this all mean? It means that people are putting a lot of money into manufacturing, and manufacturing needs money, not just for the plant, but also for the appurtenant real estate. So one of my ideas is, number one, you should be financing these manufacturing sites. But if you're too afraid to do that, you should finance the data center, which is next door. You should finance the multi-family, which is next door. You should finance the retail, which is next door. And for all those folks who are skittish on manufacturing, how many of you are now doing data centers? What do you think you're doing in there, right? You're doing serious, high-tech, high electrical, high water use stuff that has no alternative use at the back end. Just like manufacturing, but you are throwing every last dollar into data centers, but you're scared of manufacturing. I ask you to look at that differently, but also look differently at the appurtenant real estate around it, which will give you opportunities in traditional forms of real estate. And here's one step further. This may be a step too far, but some of these are in what you would have traditionally considered to be secondary and sometimes tertiary markets. And then every institutional antenna goes up and says, well, I'll never have liquidity on the back end. I can't do it. Well, I was just in a meeting an hour ago. We talked about New Albany, Ohio. And by the way, for my listeners of my show, you know, it kills me to say this since that's a suburb of Columbus and my son goes to Michigan. But nevertheless, New Albany is a great example of this. It has the new Intel chip plant. It has the new data centers. It has all the pertinent real estate. And in the last meeting I just had with one of the biggest institutional investors in the world, they said that Columbus, Ohio is no longer a secondary market. How about that? That's the kind of transformation that happened there. And so it brings me back to the point, if we are in a de-globalizing world, you should follow the money, and follow the money not just to the manufacturing sites here. You should be following it to the manufacturing sites in Mexico. You should know that last year, China was the #1 investor in Mexican manufacturing to the tune of, again, I'm going to be slightly wrong on this stat, over $20 billion. A lot of money. Follow the manufacturing. You will find opportunities in both that and in traditional forms of real estate, most notably multifamily. And that's actually another one of my top 5 ideas is multifamily in Mexico. And the reason for that is because everybody has run away from it. And they've run away from it because it's peso denominated and they're afraid about the volatility there. They're also afraid about landlord-tenant laws, which is precisely why somebody needs to figure it out, because that reminds me of where multifamily was in Europe 15 years ago. Somebody figured it out, and now it's a major institutional asset class.
Dígame más, por favor. I mean, tell me more. What do you see happening in Mexico?
Well, I've always been a fan of Mexico for a lot of reasons, and the reasons are well known. Its proximity to the United States. Its cost of labor. The average Mexican laborer makes 10% of what an American laborer is, so it's cheaper to do stuff down there. Number 3, they are now creating what I think is the most important thing, which are, there's a lot of ways to frame this, but I'll frame it as virtuous cycles. The reason why China is the world's biggest manufacturer, you can't just pick it up and move it, right? Because they have virtuous cycles over there where all the plants are near each other and they can service each other and they can supply each other. And Mexico, given all this new money that's coming in there, will soon have something very similar to that. And they'll have the added advantage of cheap labor and proximity to the United States. And many of these asset classes, most notably industrial, are priced in US dollars. And if it's priced in US dollars, you don't have to worry about the peso fluctuation as much. But nevertheless, I have some clients who have bought peso denominated assets down there, including retail, and have done very well with peso denominated funds. So see the opportunity for what it is from a real estate perspective, and then structure your capital in a way that it can exploit it.
Fascinating. It's been interesting to watch too, because you talked about labor and demographics, right? And I think there's a lot of people now that are coming up from Central America that actually aren't making it all the way up to the United States, is they're like, hey, I'm in Mexico. I got a good manufacturing gig here at this car plant. Like, life's fine. And so it'll be interesting to see how much that mitigates, especially with this new president in Mexico, but how much that mitigates the immigrants hitting the U.S. border. So you've mentioned China several times. I may get some of these numbers wrong, but I know there was a recent bailout China for the real estate industry. I think it was 1.38 billion, around there. I just want to know from you, how do you see—
It might have been trillion, but go ahead.
Trillion, excuse me. Did I say billion? So yeah. Anyway, it was a large number.
That's our Dr. Evil moment. Every time we say million, it's a billion. No, it's a trillion.
Was it 1.38 trillion? Is that the right number?
It sounds closer to
it was some. I mean, it was. You're just like, holy cow.
Yeah.
My question to you is, how and if do you see that bailout, that liquidity impacting the United States real estate market or the situation here in the U.S.?
So let's go macro first, then we'll go micro. So macro, when you're taking a look at bailout situations like they have in the Chinese real estate market, like they had in the Irish real estate market back in the global financial crisis, the first thing you have to look at is the debt to GDP of the country. And so China's debt to GDP, and again, I'm going to be slightly wrong on this number, but was something like 70 or 80%. And the US is now about 110%. And what does that mean? It means that China had headroom to absorb some of those losses at the federal level. Ireland had a bigger problem because their debt to GDP was much higher. But debt to GDP can get a lot higher, and you can get away with it if you have low interest rates. And that's Japan, because Japan's debt to GDP is approaching 300%. Again, slightly wrong, but that's approximately correct. And so it brings you back to the Chinese real estate problem. The Chinese real estate problem is absorbable by the Chinese economy if they continue to grow and interest rates stay reasonable. Okay, reasonable meaning not hyper interest rates, but also, but there's another issue here which has to do with the deglobalization thing we talked about a moment ago. I'm not suggesting— I had a dinner the other day, and there was somebody that was a defense contractor, and we disagreed. And we disagreed on the point of, should we have more China trade? Should we have less China trade? And I said we should have more, because if we are working together with them, we have a better chance of there being less geopolitical problems than less. They took the opposite tack. Okay, so there's reasonable minds can disagree on that point. But from my perspective, I still want to see foreign capital going into China, much like I still want to see Chinese and other foreign capital coming here. And so the issue with the Chinese real estate market is there'll be less foreign capital going there from our industry, which I don't like, which is bad. But I think if there's any good news in what is a pretty serious downturn in the Chinese real estate market, is that federally, if China continues to grow, they can absorb it.
When you say continue to grow, do you mean just strictly GDP, or because obviously the population, and you talked about labor and demography, right? Their demographics are not showing they're going to continue to grow.
It's GDP.
Okay.
And so I've got bad news for all my federal deficit hawks listening to today's show. The federal deficit will never get repaid. Ever. And it never was. As a matter of fact, if I were able to break down the federal debt to its last penny, I bet you there's money in there from the Revolutionary War. Literally. I'm being literal here, because it's never intended to be repaid. The way that it works is that the economy grows faster than the debt grows, and the debt becomes a smaller percentage of GDP. That's how the math works. That's why there's two things that can shrink national debt. Number one is faster growth, and number two is a little bit of inflation, because the national debt is priced in nominal dollars. Inflation is in real dollars. And so the bottom line is that a little inflation, little growth shrinks that national debt. So Thomas Jefferson, you didn't think we were going to get a Thomas Jefferson quote on this show, did you? So Thomas Jefferson famously said that a little revolution every now and then is a good thing. Well, you know what? A little inflation every now and then is a good thing too, because it shrinks the debt. Too much inflation is a really, really bad thing, which is what we're experiencing now. But a little bit of inflation to reduce debt does help.
Boy, didn't think we were going here today, but we might as well go there. So it's fascinating you bring up the debt, because I was on a podcast I did recently with a guest, and I said, this is going to sound like a crazy question, but I'm going to ask it anyways. Does the debt really even matter anymore? And it sounds like you're kind of saying, I don't know.
No, it does. It does. And I'll tell you why. There was a fancy economics thing a few years ago known as modern monetary theory. And I'm not going to get into this in the show, but the crux of it was that the debt and deficits don't matter, right? Well, that was in the never, never land when interest rates were zero. Well, we are not in that never, never land anymore. And what does it mean when interest rates go up by 100 basis points? It means that 270 billion, which is 1% of the national debt, gets thrown into the financial furnace every year rather than going to productive uses. And what's a productive use? A road, a school, a hospital, 5G. We can all come up with what productive uses are. It's not productive to service the debt. And to what is growth? Growth is only two things for my fancy economics 101 friends out there. Growth is the combination of population growth plus productivity growth. That's it. That's the whole fancy formula. As noted, population isn't growing as fast, and productivity will get squished if we don't use our money for productive purposes. So the bottom line is that debts do matter, deficits do matter in a high interest rate environment, and we are certainly in the higher for longer environment today.
So with that being said, I did listen to the Weekly Take, several of your episodes, and you had a recent guest, I think it was just released yesterday or the day before, that suggested 2 rate cuts this year, one possibly even in September. So I want to get your take on that, because your other guest says, oh, the Fed's completely, apolitical. I don't know if I buy that, but I want to get your take on that. And then your guest also said that he sees 3 rate cuts in 2025. What say you?
I think we're out of time, Chris. No, I think we. I say that tongue in cheek because look, we got it wrong last year. We got it wrong the year before that too. Inflation ran hotter for longer, and the reason was not because we were completely wrong. It was that the federal government intervened so strongly as related to Silicon Valley Bank, as related to Signature Bank, as related to the guidance they've given these regional banks to kick the can down the road, that it forced interest rates higher. It forced the labor markets to stay strong, which as an American, I'm very happy they did. But as a real estate professional, I'm not, because it artificially kept interest rates high for way longer, which is doing incredible damage to our business in areas that you're all keenly aware of. Now that I said all that stuff, I'm in the camp that I'm actually in the camp of more cuts rather than less. I know some people who are at 0, and I think our house view is 2. I wouldn't be surprised if there's 3. And why? And I wouldn't be surprised because I think that the headline numbers in the economy mask what is significantly greater weakness below it. And the significantly greater weakness below it isn't just in our business. It is in your kids going out to buy a car. Good luck getting a loan, and at what cost? It's in a small business that's on a floating rate line of credit that quadrupled in cost. Good luck that company staying solvent. So I think there's a much more weakness in the underlying economy than the headlines would suggest. I think the consumer is now out of money. I think that has showed up in quarterly earnings in Target, in Starbucks, in McDonald's. So I think there's more cracks there than people think. And is it fair to say that there is an election coming up here in November, and that maybe the Fed doesn't want to get blamed one way or the other for its outcome? The Fed will deny to the highest mountain in the world that they'll ever consider that stuff. I'm not so sure.
So just to be clear, you're suggesting 2 to 3 maybe this year, and then 3 next year, potentially?
Yeah, I think our house view is 2 this year, 3 next year. I might be 3 and 3. I mean, listen, I'm not materially off our house view. I'm just saying I'm looking at the tea leaves a little bit more pessimistically on the macro economy than some of my colleagues.
I know we've got got you for a limited amount of time. I'd love to do this again. But with that being said, we went some places today I think we were going to go. We haven't even talked about the refinancing of CRE loans and the impact that's going to have on regional banks. Jerome Powell was on 60 Minutes just a few months ago. It's like, I don't really see any issues in regional banks. I don't think there's going to be any there. What say you? I mean, an article today where pension funds now are getting hit because they're trading out some real estate deals that they're taking losses at. There was another article yesterday came out that said, hey, banks are much more exposed to CRE debt than we originally thought because of the REITs. What's your assessment of?
Well, here's just a couple of basic numbers for you. Okay, again, approximately right, not specific, so don't hold me to these exactly. But the average money center bank, the big banks here in Manhattan, they have less than 8% of their books, of their total loan exposure to commercial real estate, less than 8%. My understanding is that the average regional bank is over 20%. So that just gives you the magnitude of the challenge at a money center bank versus regional. It's night and day, which is why they're acting differently, which is why you're going to see money center banks more inclined to take the assets back than will be a regional bank, which will kick the can down the road as long as they can. That is one of the X factors of the risks that are out there that could change the Fed's tune quickly. If we see a rash of bank failures, the Fed will turn tail much more quickly, but they've done everything they could to prevent that, because they've de facto, they haven't done this de jure, it's not actually the law, they de facto secured all bank deposits in America with Signature Bank and Silicon Valley. Now, I've said this before, I'll say it now, I think they should absolutely guarantee all bank deposits in America, because they think, oh, moral hazard and people take risks. That's what the equity and the bonds are for in the banks. People shouldn't be taking risks with deposits, but put that aside. The regional banks do represent risk because of the percentage of their exposure to our sector. Pension funds are getting hit if they have to take the losses today, not just on loans, but even in, obviously their equity positions. So that's a big risk, a risk that we didn't talk about on the show. And again, I'm not here to throw any asset type under the bus. I'm actually a huge housing advocate, but multifamily has more stress than people realize, the average person realizes right now. And the reason is that the average multifamily buyer bought it at the peak of the market between 2019 and 2022 and used floating rate debt. Well, guess what happens when you got to refinance? Problems. When your cap rate goes up by a couple hundred basis points and your cost of debt goes up by a couple hundred basis points, sometimes your equity doesn't have any value. So I think there are real cracks, both from a systemic standpoint, which is the regional banks, and then from our industry, we've got to find a way to solve that multifamily problem. And I think it's going to be most severe this year, because I've seen the numbers where most of these floating rate debts are coming due.
So do you see a regional bank major issue in 24, 36 months?
No, I don't, because I think interest rates are going to come down. I think they've kicked the can down the road a lot. And also, they've been writing these loans down. They've been writing them down over the course of the last 2+ years. And so by the time they actually got to face the music, they'll have written it down enough that it won't have the catastrophic damage to their balance sheet if they had to take it all at once.
Got it. So much more I want to discuss with you. I know you've got a limited amount of time, so I just want to say thank you for being here today and give you the last word. Anything else you want to add or share?
I got into this business in the early 1990s working for a developer right here in New York City. And we were buying buildings in the Wall Street area for $100 a foot and less. A lot of those buildings are being sold today, or the condominium units in those buildings, for $4,000 a foot or more. I was just in Charleston, South Carolina. The best condominium units down there are selling for almost $2,000 a foot. So this is not just a Manhattan thing. The opportunities today to build intergenerational wealth in the real estate business are the best I've seen since the early 1990s. You need to find ways to build your capital stack, probably using high net worth money. But if you can find a way to find the money, you will have an intergenerationally great opportunity today, notwithstanding all of the negative news that Chris and I have discussed.
Although I will say thank you for wrapping up, because it lines up perfectly with the mission of the show. So I appreciate very much how you just did that, talking about building generational wealth with real estate. Also want to give people a chance to reach out to you. How can they go listen to your podcast, by the way, is fantastic. I don't know who your producers are, but I would love to meet them, because they do an incredible job, as do you. So how can people check out?
So anybody who listens to this, please listen to the Weekly Take by CBRE. And anybody who sends me a friend request on LinkedIn, you can do that, and I'll friend you as well, because I have all kinds of funny little videos, at least I think they're funny, of all my travels around the world and little ditties about what's going on in the real estate business. But I'm a friend, not just to CBRE, I'm a friend to the industry, and I'm happy to speak with any of your listeners.
Thank you. Spencer Lieber, we appreciate the time. Keep up the great work. We look forward to having you back, okay?
Thank you, Chris.
Thank you. Have a great day. Again, the Commercial Real Estate Report, empowering you to build generational wealth.